It feels to us that the bond market has moved too far, too fast. Looking ahead, we think that the recent repricing higher in interest rate expectations will begin to weigh on both the consumer and, critically, the corporate sector into 2024. Equity and credit markets are now beginning to digest the risks of an extended period of restrictive monetary policy. So we believe that the deterioration in corporate fundamentals over the next 3 to 6 months will also result in weaker labour market activity as companies cut jobs. Consequently, we expect the US economic outlook to become less rosy, and this is against the backdrop of an already weak global economy, elevated geopolitical risks, and a stronger US dollar, where financial stability risks are also growing. Given these macro views, in our opinion, there's an asymmetry to global bonds into next year, with more scope for lower yields than higher bond yields. It is fair to say that the big bond reset that began in 2022 has continued for longer than many investors had expected. Global bonds have come under significant pressure. It's been a tough time to navigate rates, with 10-year Treasury yields now close to 5%, their highest levels since 2007. In fact, never before have 10-year Treasuries posted negative total returns for 3 consecutive years, and the global aggregate bond index is now down roughly 25% from its highs at the end of 2020. In the core fixed income team, we've analysed 50 years of interest rate hiking cycles and assessed the performance of US Treasuries versus cash. And traditionally, US Treasuries start outperforming cash 3 to 6 months ahead of the peak in Fed funds. But this has not happened yet in this cycle, and we are long overdue a bond market rally, given our much weaker global growth outlook on the back of tightening financial conditions. With the big bond reset, sovereign bonds now look attractive, given the gloomy global growth outlook heading into 2024. In terms of our core fixed income strategy, weaker growth, lower inflation, tighter monetary and tighter fiscal policy, attractive bond market valuations, with 10-year Treasury yields, the real yields close to 2.5%, which is deep into restrictive territory. Therefore, recently, we've been increasing overall interest rate risk across our portfolios and adding a basket of yield curve steepness across all of our strategies. We've also been reducing overall spread risk to remain defensively positioned in credit at this such late stage in the economic cycle. We plan to keep layering into more interest rate risk going forward, given our macroeconomic views. One of the key risks is the outlook for inflation and whether the Fed needs to keep raising interest rates, which is not our base case. In fact, we think that the Fed is very close to or at the end of their rate hiking cycle. Other risks to our long interest rate duration position are that central banks increase the pace of quantitative tightening, and this could trigger further bear market steepening in yield curves. But this is also likely to be negative for credit spreads, where we are very defensively positioned. If these risks rise, we'd look to be more patient before adding more interest rate risk, and we could also add to our current long US dollar FX currency positions. Also, all things considered, given the risks of a policy mistake and a hard landing scenario, we are unlikely to add spread product at this stage in the economic cycle. We are aware of these risks. However, we see opportunities in global sovereign bonds and long US duration exposures, as we feel that the Fed may struggle to engineer a soft landing for the US economy in 2024. Therefore, to conclude, a highly flexible and fully unconstrained strategy would be beneficial in this type of environment.